The Federal Reserve has prepared for much larger banking crises to come. And this program is the program that, without calling it quantitative easing, is going to keep the liquidity from locking up in such a way that the banking system collapses. Welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser. For those of you just joining this podcast for the first time, if you got referred by a friend or a relative or a family or a coworker, I am Rebecca Walser. I have an undergrad in finance. I worked in finance in the corporate world with PricewaterhouseCoopers and IBM AT&T and real estate finance for over a decade before I became a lawyer. Went to University of Florida, became a lawyer, went to NYU, got my advanced law degree in tax. And I additionally have a global MBA from the London School of Economics. That's who I am. So let's get started on this market, this crashes and taxes for September 15th. This is going to be a very narrowed, tailored crashes and taxes. I want to talk to you about one specific thing that I don't think Americans understand, and I need them to understand it because I've talked about the severe lack of liquidity consistently, yet we keep seeing the economy strong. We keep seeing things continue to go well. And so people are getting really disoriented on the messaging. How is this possible? We see that savings rates are declining, although we saw that people started to pick up their savings rate at the very tail end of August. So that's confusing. And then credit card debt is soaring. Over $1 trillion for the first time, really under this administration. But that's not really, I'm not going to put that on the administration because that's just as a result of all of the money that flooded into the system through the stimulus after coronavirus. So that's definitely not this administration necessarily. But what we're seeing is, a lot of different economic indicators in opposite directions. So I want to explain how and why the economy so far and the banking situation especially has been able to be sustained so long. So let's go ahead and get into this. And the first thing I want to point out is, and I might just take off so I can see you guys. The first thing I want to point out is this Seeking Alpha article. Now, this comes out in March of 2021, and it's literally discussing what is happening with this new program, which is the BTFP, and that's the Bank Term Funding Program. And the Bank Term Funding Program came about in basically it was announced middle of March 12, 13, by the Fed that they were going to have a new facility instead of just the regular discount window facility for overnight lending, which is highly regarded as a bank. If they have to borrow from the Fed overnight through the discount window, it's a very big red flag. So banks try to avoid that at all costs. And instead they borrow from their peers and they do what we call peer-to-peer lending overnight using Fed funds. That's the Fed funds rate. So the discount rate, not so much. But the BTFP, similar to the discount window, is a credit facility that is a direct loan from the Federal Reserve. So this article starts to talk a little bit about what is the problem with this new program and what the program is. So QE, or quantitative easing, has been the bull's siren song of the last decade, but will not QE be the same, meaning BTFP. While the BTFP facility is technically not QE, it does reverse the Fed's efforts to reduce financial liquidity. With inflation running at the highest level since the 1980s, the Fed risks creating another inflationary and interest rate spike if they focus on financial stability. In other words, if they focus on tapping down inflation, we're going to have a problem. So what's happening here is that we have this new facility that came about because of the fact that we had Silicon Valley Bank, SVB, and we also had Signature Bank at the same time in early March beginning to fail. And the Fed knew that snowball effect always comes when banks begin to fail because you create market panic, psychological market panic from humans. And the banking system, I've said this multiple times before on this podcast, the banking system by definition is insolvent. It is by definition insolvent, because when you open $100 at a bank account and you deposit $100, they are not keeping John Smith's new account $100 in it for John Smith to come get anytime he wants. No, they're supposed to be keeping $10 and they're lending out 90, and that's what we call the money multiplier effect. And that's why anytime we're pre-recession, pre-depression times, you see one of the leading indicators is the bank lending requirements, the strictness of the bank lending requirements always before a recession or depression, or at the beginning of a recession or depression, shoot straight up. And that has happened this time. We've absolutely seen it happen this time. And therefore, we are looking at, that to be happening again. So what is this BTFP? If it's not actual Federal Reserve stimulus, what is it? Well, the first thing I think is important to note is the actual sheer size and volume of what this is, because it is not quantitative easing, but it is something else. So let me explain first what quantitative easing actually is. So quantitative easing, and I can just, since I'm not on a slide right now, I can go ahead and make myself a little bit bigger, because we are here trying to understand the Federal Reserve's new bank term funding program in response to the bank failures that happened in March. This was a large law firm in America discussing and detailing in a white paper exactly what this new BTFP is. And so what you need to understand is that when the Federal Reserve does open market operations, it actually goes out and it is creating new money. It is basically in a debt-based way, creating money for the Treasury Department. So when we stimulated through coronavirus, when the Federal Reserve printed trillions and trillions of dollars through coronavirus, what happens is though they're creating new dollars. Now, Jerome Powell was interviewed by 60 Minutes, and he said it's pretty binary. It's zeros and ones, mostly on computers, not a lot of actual hard paper printing cash. And of course, they don't want a lot of hard paper printing cash because they're trying to make us move to a cashless society. That is a definite goal. Digital dollar on the FedNow platform. The FedNow platform launched in July. Digital dollar will come after digital ID, because remember, in order to go truly digital, you must be able to verify the veracity of identification. And in order to do that, you must have digital ID. Digital ID is a huge totalitarian communistic type of tenant, because once you have digital ID, you can now completely block everybody from everything. You'll no longer be able to log into your phone internet or to the internet at all without a digital ID. Therefore, a complete autonomy is gone, and now they know everything that you're doing, and there's complete tracking. This is the beginning of a totalitarian, communistic, complete government-controlled type of society. But that's, we got off on a tangent over there. I'm coming back to BTFP. So when the Federal Reserve is normally operating and they're quantitative easing, they're creating new money. They are going out and actually creating money in the system, mostly digital, as Jerome Powell said himself. And then the Treasury Department is basically how it becomes US dollars is the Treasury Department is borrowing it. And so that is why our federal debt becomes so large. We're basically borrowing that money to have additional money supplied to sustain our economy, and we're paying interest. Now, the Federal Reserve is the one collecting this interest, and normally we are in a net interest positive situation. Right now, we're in a net negative interest situation because the Federal Reserve has $7.4 trillion still. They've reduced their balance sheet by $1 trillion, but they still have over $7 trillion on their balance sheet. And the money they have on the balance sheet is at the interest rates pre Jerome Powell raising rates. Because if you remember, we stimulated through coronavirus, and we didn't start on a rate raise campaign. We had that entire year they were saying it was transitory before the rate raise campaign really began in earnest. So what you're seeing is a net negative interest rate situation right now, where the Federal Reserve is actually paying more on their reverse repos, which is their competition for money market program. So they are basically paying more interest on money market accounts that they are, the treasuries are at 4% right now, versus their long-term bonds that they issued and bought when we were in quantitative easing through the pandemic, which were definitely in the twos, much less twos and threes. So we have a net negative situation. So, and also the Federal Reserve is supposed to be quantitative tightening. We're supposed to be selling 60 billion of treasuries a month and 35 billion of mortgage-backed securities. So almost 100 billion a month we're supposed to be reducing from the Federal Reserve's balance sheet and sucking that cash back in from the economy. And that, of course, is starting in October, has been going, but October, we're starting to resume student loan payments. That's $5 billion that will be sucked out of the economy a month. So you talk about the Fed's quantitative tightening of almost 100 billion, the student loans restarting of 105 billion, that's 105 billion that's going to be sucked out of the economy. But when March happened, and the Fed was already on this interest rate increasing cycle and didn't want to go back into QE, because how can you do QE while you're raising interest rates at the same time? These are exactly opposite economic strategies. And they would, you just don't do two opposite things at a central bank at the same time. And it makes no sense. So they had to figure out a new way to basically help these banks. So they created a new program. It's called the Bank Term Funding Program, BTFP. It is a one-year program. It expires literally on March 14th of 2024. And this is not new money creation. What this is basically a direct loan from the Federal Reserve to a bank using the bank's own securities as collateral. So basically the banks have obviously collateral that they hedge and insure the deposits that they have on consumer deposits they have on file. And so they're always collateralizing that through treasuries and all kinds of things. And the Fed is taking the bank's securities as collateral and lending direct loans to help the liquidity situation of the banking system. Now, where it becomes a problem is the valuation. So let's just read here. Borrow eligibility. To borrow under the BTFP, an institution must be a U.S. federally insured depository institution, bank, savings association, credit union, U.S. branch or agency of a foreign bank, so on the U.S. soil, and be eligible for primary credit. Eligible collateral includes U.S. securities, agency debt, and mortgage-backed securities and certain other qualifying assets. Eligible collateral must be available for purchase by the Fed in the open market, must have been owned by the borrower as of March 12th. Under the BTFP, a borrower can borrow up to the value of its eligible collateral. However, for the purpose of BTFP, pledged collateral will be valued at par and not at its mark-to-market value. This means that the deterioration in value of long-term securities caused by increases in interest rates since 2012 will be ignored entirely by the Federal Reserve for the purposes of valuing the collateral. This is huge. This is absolutely huge, you guys, because think about this. If you have a pension, let's say your pension is $1 million sitting at a corporation, and they're going to pay you the rest of your life, but they give you the option to be bought out. You can be bought out of this pension. We will discount it back to a net present value, and we will give you this money. Well, 2-3 years ago, that discount factor was extremely low, maybe 3-4%. So $1 million discounted at 3-4% might give you, and I'm making these numbers up, these are not mathematical calculations, but $1 million discount 3-4%, let's just hypothetically say that gave you a net lump sum payout of $750,000. Well, now that the interest rates have gone up so much, that $1 million is getting discounted back at its basically the current going rate, which is somewhere in the sevens. And so that $750 might now be $550 or $600. It's massive deteriorations in value. We're talking about 25% deterioration at a minimum. And so what is concerning here is that the Federal Reserve realizes that these long-term securities that the banks are holding, that they are holding as collateral for what this borrowing program dollar for dollar is going to be, they know that this collateral is no longer valued at that level, yet they want to continue to offer this level of credit in the interim. Now, Bloomberg had this article on March 15th so that we can understand the scope of this program and how massive this is, or could become, I should say. Bloomberg noted in 2015 that JP Morgan Chase analysts basically saw that this could inject anywhere up to $2 trillion in liquidity directly into the banks as a backstop. Now, this is problematic, and let me explain to you why this is problematic. As Bloomberg notes, major banks like JP Morgan will likely not tap into these direct Fed lending program due to the stigma often attached to such usage, meaning that your bank is probably insolvent and has liquidity problems, and you don't want to send that kind of message to your customers. So it's saying that the big banks are not going to make use of this program because of the stimulus or the stigma attached to it. However, there are roughly $3 trillion in reserves in the U.S. banking system, of which the top 5 major banks hold a significant portion. So this is from March of 2023. This analysis shows that there's about $3 trillion in reserves in the U.S. banking system. But I need you to understand that what they're stating is that while the largest banks will likely not participate in tapping into this program, the fact that the maximum usage envisioned for the facility is close to $2 trillion, which is the par amount of bonds which are held against by U.S. banks outside of the 5 biggest. So in other words, we understand that these bonds have deteriorated substantially in value, not minimally, not de minimisly, but substantially in value. The Fed is going to ignore that and still take their par value. And they are stating, and the analysis shows that this program is able or willing to inject up to $2 trillion when our total U.S. banking system reserve is at $3 trillion. The Fed obviously caused this problem by aggressively hiking rates, which drop collateral values. This has left some banks which didn't hedge their loan and bond portfolios with insufficient collateral to cover the deposits during a bank run. So what I'm trying to let you guys know is that the Federal Reserve has prepared for much larger banking crises to come. And this program is the program that, without calling it quantitative easing, is going to keep the liquidity from locking up in such a way that the banking system collapses. This is the facility. If you want to understand what happened immediately, you can see March 16th. Immediately, the program was announced on the 12th, and by the 16th, there was already $164 billion that had been loaned directly by the Fed to backstop liquidity. It was $12 billion in the first 3 days alone. Okay, so let's get the update. Here's the update for what the actual amount is as of now. You can see that as of August 31st, this is the September 11th report we got this week, and as of August 31st, the total outstanding under BTFP was $121.2 billion, and the total value of the collateral was $145.4 billion. But again, remember that collateral is valued at par and is probably at least 25% overvalued. We could do the math and see that we'd have to know the portfolio and the loans, and we don't have all that information, but we know that it's not any longer valued at 145B. So this is the problem, you guys. We have a situation where we do have a program that is envisioned to potentially backstop banks directly up to $2 trillion. And you have to start asking yourself, why in the world do we need such a huge backstop? That's the question. Why are we so prepared to backstop the banks during an economic collapse and failure? And then the bigger question probably has to be, what makes this Federal Reserve dollars worth it when we can just we had the coronavirus collapse and we stimulated through it with quantitative easing. We had too big to fail in 2008, 2009 global financial crisis, and we stimulated there. We recapitalized the investment banks in 2019 Q4, $11 trillion. Like, we cannot just print. The American people and the world, more importantly, is going to realize, and really has realized, that we are just manipulating our currency, printing dollars at will, and they just don't mean anything. And that's the point that we have to be very, very scared about, is when is the world going to realize what America is doing and realize that these dollars are just not worth it anymore. You just can't print money. It really, truly does not grow on trees. There are economic impacts every which way to Sunday. So really, you guys, that's all I really wanted to share with you guys today, is just understand this program and be ready for the implications and what it means. Hope you guys are doing great. Until next week, have a great week, everybody.